Let's talk about something nobody really likes to admit. Debt. It's a four-letter word that's quietly suffocating American families. As the second quarter of 2024, the total credit card debt in the United States has hit a staggering $1.142 trillion. Let that sink in for a second. $1.142 trillion. This is the highest credit card debt ever recorded in U.S. history, blowing past the pre-pandemic high of $927 billion. And the worst part, we're still climbing. This is not just a statistic. This is your neighbor, your coworker, your family, and maybe even you. The reality is, life has become more expensive than ever. Groceries, gas, medical bills, everything has been rising except for your paycheck. And with interest rates on credit cards continuing to climb into double digits and beyond, families are struggling just to keep their heads above water. What happens when those interest payments become too much? Delinquencies, defaults, stress, strain, divorce? Families are being crushed under the weight of this rising debt, and the cracks are starting to show. It's heartbreaking to think that financial stress is robbing parents of precious time with their kids, creating tensions in their marriages, and causing sleepless nights, all because we're barely getting by. But here's the twist. While debt is going up, something else has been quietly rising too: your home's value. Even with all the talk, your home continues to appreciate. As of March 2024, the average American homeowner with a mortgage has more than $299,000 in home equity. Out of that, $193,000 is considered tappable. This means you can access that equity while still keeping a safe 20% buffer in your home. Just think about that for a second. If you had $193,000 of tappable equity is just sitting there, waiting to be used. It makes us feel good, but we haven't actually used it. It's just sitting there. So why are we letting our biggest asset, our home, sit on the sidelines while we drown in debt? Why are you continuing to pay 15, 20, or even more in interest rates on credit card debt, while you have an opportunity to restructure that debt and put your family in a better balanced position? It doesn't have to be this way. It's real simple. Life is expensive, yes, but you have the power to make it more affordable. Right now, rates have come down to a point where it makes sense to start the conversation about consolidating your debt. By tapping into your home equity, you can lower your monthly payments, increase your cash flow, and most importantly, reduce the stress on your family. Picture it. No more scrambling to meet minimum payments. No more sleepless nights worrying about those bills. Instead, you can focus on what really matters: spending time with your family, planning for your future, and living a life that isn't weighed down by a crushing amount of debt. By taking advantage of your home's equity, you're not just paying off debt, you're giving your family a future. The interest payments on your credit card debt are stealing from your family's present and future. While the solution is right in front of you, inside your home, it's time to wake up and take control. Rates are in a position where you can finally make that move. You can give your family a gift of stability, of security, of breathing room. It's time to act now. Don't let this opportunity pass you by while life continues to get more and more expensive and debt continues to pile up. Take control of your financial future today, because your family deserves better. Let me walk you through a real world example of a family right here in downtown Woodstock, Georgia. They bought their home in 2019 for $400,000. They put 20% down, which is pretty standard, in this particular community. By 2020, they refinanced to an incredibly low rate of 2.875. That's phenomenal, right? But fast forward a few years, and like so many of us, they found themselves buried under debt, over $60,000. The cost of living skyrocketed, and suddenly they're juggling more bills than they could handle. Now, Some people might be quick to judge. How can someone rack up that much debt? Let's be real. This is way more common than most of us realize. I see this kind of situation literally on a daily basis. Life gets expensive. Unexpected expenses pop up all the time, and before you know it, you're staring at mountains of credit card debt. Here's what this borrower was dealing with. $35,000 in a personal loan, draining $650 a month. $9,800 on a Visa, adding another $450 monthly burden. $15,000 on an American Express, with $550 vanishing into that payment, and another $8,000 on a MasterCard, costing them another $350 a month. That's a total of $67,000 in debt. And the monthly payments, $2,000, just to cover the debts. Now, combine that with their mortgage, taxes, insurance, and this family was just bleeding $3,695 every single month. The strain on their finances were unbearable, and it was affecting every part of their lives. They were just trying to survive, not thrive. But here's where the game changed. They had equity in their home, a lot of it. With a property value of over $700,000, they had built up $414,000 in equity. Tappable equity, there's a lot right there. That's more than enough to change the financial future. So they made the decision to consolidate that debt. We refinanced their mortgage, rolling that $67,800 in debt into a new loan. Sure, the new interest rate was higher, 6.75% compared to that 2.875 they locked in a few years ago. But guess what? Their monthly payment dropped from over $3,600 to $2,700. That's $980 back in their pocket every single month. That's almost $1,000 in savings. And we're talking about cold, hard cash that can be used to help their family breathe a little easier. So what does this mean for them? With that extra $982 a month, they're no longer scraping by just to pay bills. That's money they can save, they can invest in their kids' future, they can build up an emergency fund, or simply have a cushion to enjoy life. Imagine how much stress would disappear from your life with an extra $1,000 in cash flow each month. Now, how much more time could you spend with your family if you weren't working overtime or picking up those extra shifts just to make ends meet? This isn't just numbers on paper. This is real life. This is freedom from crushing debt, freedom from constant worry, and freedom to build a better future for you and your family. When you're in a position like this borrower, sitting on a massive amount of debt while your home equity grows, you need to ask yourself, why are you allowing your biggest asset to just sit there? Why aren't you using that equity to restructure your life and help your family out? This Woodstock family did, and now they're not just surviving, they're absolutely thriving. Look, I know some of you might be thinking, I'm not drowning in debt, so why would I even consider this? And I get it. On the surface, it might seem crazy to swap out your low interest rate mortgage for a higher one, but let's get real for a second. This isn't just about the interest rate. This is about options, and having options is a powerful asset in itself. It gives you the ability to take control of your financial future rather than just coasting along on autopilot. If you're not struggling with your monthly payments right now, that's fantastic. That's great news. But what are you doing with your extra cash? Let's say you go ahead and consolidate some of that debt that you've got outstanding and you just pull some equity out. Sure, your mortgage rate may go up, but let's talk about what that actually means. If you take that savings and apply it directly towards your principal, you could shave off years off your mortgage. In my previous example, that would be 11 years off their mortgage. Think about that. You could be debt-free 11 years sooner from your mortgage than you thought. That is not just a small perk, that's life-changing. Imagine what you could do with that extra decade of financial freedom. You're no longer stuck in the grind of a monthly mortgage payment. That's 11 years of no more checks to the bank, no more being tied to a loan. And if you're not interested in paying off your mortgage earlier, that's fine too. You've still got options. Again, that's the point. You could take the newfound savings and invest it, put that money into the market, into an income-generating property, or even start the business you've been dreaming about. Or if you've got children, sock that money away into a college fund. Give them a head start in life that maybe you never had. The point, again, this isn't just about lowering monthly payments. It's about creating opportunities. You're unlocking options that weren't there before, and options are what separate those who are just getting by and from those who are thriving. Having financial flexibility isn't something to take lightly. It is an asset in and of itself, and you can't put a price on that. Let's stop thinking about interest rates like they're the only thing that matters. Sure, locking in a low rate is great. Absolutely. We want to provide the lowest rate possible, but it doesn't mean much if you're sitting on the sidelines with no room to maneuver. Give yourself the ability to move money around, invest where it counts, or simply breathe a little easier. You owe it to yourself. You owe it to your family to look at every possible angle. This isn't about giving up a low rate. It's about unlocking that freedom. You've worked hard for the equity in your home. Now it's time to make that equity work for you. So how do we actually go about making this happen? Here's a step-by-step on what it takes to turn your home equity into real financial freedom. First off, you need to find a mortgage professional you can trust. Whether it's me and my team or someone else, the key here is trust. This isn't something you want to hand off just to anybody. You need someone who has your best interests in mind, someone who's not just looking to close a deal, but wants to help you make the smartest financial possible. You want an advisor, not a salesman. Once you've got your mortgage professional lined up, the process itself is pretty straightforward. You've gone through the process already when you purchased your home or refinanced in the past. You'll start with a loan application. They're going to need you to pull your credit, which helps determine what kind of rates you'll qualify for. You'll need to provide your income documentation, pay stubs, tax returns, that kind of thing. Nothing out of the ordinary. It's all standard stuff. It will depend upon what your application looks like. Next up, you're going to have an appraisal done on your home. This is a big one because it tells us exactly how much equity you're sitting on. Now, there is a cost associated with the appraisal. Typically, it ranges anywhere from $500 to $600. And yes, this is usually paid out of pocket, but typically that's going to be the only out-of-pocket cost throughout the rest of the process. Most of the other costs, or all of the other costs, can be rolled into the loan. So you don't have to worry about coming out of pocket for any of the bigger stuff. Now, that said, you'll want to discuss this with your lenders. There's no doubt about it. Sometimes there can be a benefit to paying certain costs up front. It's something worth exploring and at least asking about. Now, before you get too deep into the process, your lender will send you all the necessary disclosures, including what's called a loan estimate. This is where you'll see the full breakdown of the fees, interest rates, and all costs associated and involved in the transaction. Here's where you need to be smart. Take a close look at the loan estimate and pay attention to the itemized fees. Some of these fees can be standard based on your state, but lender fees can vary. And this is where you've got some negotiating power. You don't have to settle for the very first offer that lands in front of you. You have every right to shop that loan estimate around to make certain that you're getting the best deal on both the rate and the closing costs. In fact, if you've already got a loan estimate in hand, want a second opinion, send it over to me. I'll take a look and at the very least give you a professional opinion on whether or not it makes sense and you're getting a fair deal. Certainly I'll do my best to try to beat it, but at least you'll have the peace of mind that you're not being taken for a ride. Now, this isn't about hard selling you on anything. It's about making certain that you're getting a fair deal and not leaving money on the table. After all, this is your financial freedom we're talking about. And the last thing you want is to be hit with an unnecessary fee or higher rate than you deserve. Bottom line, shop around and do your homework and make sure you're working with a lender who's looking out for you. And if you need help along the line, I'm here. No pressure, no hard sell, just a second set of eyes. Make sure you're making the right move. So there you have it. Whether you're drowning in debt or just looking to unlock some financial flexibility, a cash out refinance can be a powerful tool. The key is making sure you approach it wisely. Do your homework, talk to the right professionals, and make sure you're getting the most of your home's equity. This is about setting yourself and your family up for success. Not just today, but in the future. If you're ready to take the next step or you've got a loan estimate and want me to take a look, do not hesitate to reach out. I'm here to help you navigate the process and ensure you're making the smartest move possible. And don't forget, this is your money, your future, and it's time to take control of it. Thanks for watching, and as always, if you found this video helpful, make sure you like, subscribe, hit the notification bell so you never miss another one of these insights. I'll see you on the next one. This is another guaranteed video where we help you make smarter financial decisions. Catch you next time.